So, over the past week, some of the biggest giants in the market, like Amazon, Microsoft, Google, Apple, and even Meta, all released earnings reports, and some of them were good, some of them were pretty bad. But in today's video, I'm going to give my opinion on every single one of them. I'm actually an investor in each of these stocks, so maybe it'll be kind of fun for you to get my take on all of it. And I'll do a quick recap and review of all the earnings reports. I'll let you know where I think the stocks are now coming off of that and where I think they're headed in the future. And I'll even give each of these stocks a buy, hold, or sell rating based on everything we saw and where the stocks are now and where I think they're heading in the future. So should be a fun one. I hope you guys enjoy this video. But with that said, we got a lot to cover. So let's just dive straight into this list and we'll go in chronological order of when earnings were released. Okay, and first up here, we had Google and Microsoft reporting first on Tuesday after the close. And in Google's case, their stock has been climbing ever since, with the rise of almost 8% on Wednesday, the day after that they reported, and then another 1 to 2% on Thursday and Friday each, leaving them up about 8% in total for the week. And the reason why is because despite missing analyst estimates on both earnings and revenue, it still wasn't as bad as people were fearing. See, just a week prior, Snapchat had reported horrible earnings with a $400 million loss that sent their stock crashing by almost 40% in a single day, and it was largely blamed on the weak macroeconomy and on falling advertising sales. And because Google is the world leader in digital advertising, investors started to sell out of Google stock leading up to their earnings report because they thought that they were going to get, they were going to see a big hit in advertising and thus, Google earnings were going to be horrific. However, that wasn't really the case, as revenue was actually about the same as analysts were expecting, and it still came in at double-digit growth of 13%. Now, granted, that's way lower than the 62% growth that they saw the year prior, but you have to remember that was compared to 2020, and it was also boosted by the pandemic, which is not nearly as prominent now. So if you take that into account, 13% growth is really strong actually. Overall, Google stock though is still down almost a quarter of its value in what is really one of the largest dips that we've ever seen in the stock. Unfortunately though, the recent rebound coupled with lowered estimates for profitability because of the, very bad macro economy, well, all of that has raised the valuation a bit to a PEG ratio of 1.5. But even here, I still think it's a pretty good value long term because you have to consider that it's still about the same valuation as the sector, despite their massively larger size and more, dominant business that virtually dominates like all aspects of the internet. And they're already doing close to $300 billion in sales and are still managing to somehow grow by double-digit percentages every year. On top of that, at least to my knowledge, I don't think Google has ever reached a $2 trillion market cap, and I think they very much so deserve to be in that category. So I'm still buying at these prices, and especially any lower that it goes. So as far as the rating goes, I rate Google stock a buy for the long term. Next up though, we have my number one largest stock in my entire portfolio in Microsoft, ticker symbol MSFT, who like Google also reported their earnings at the close of Tuesday, which sent the stock climbing by almost 7% on Wednesday and a couple more significant gains in each of the 2 days following that as well, with an overall climb of about 8% for the week. As far as those earnings go though, well, Microsoft is actually super well known for consistently beating analyst estimates quarter after quarter, which by the way dates all the way back to 2016, which is one of the reasons why I've always loved Microsoft. It's one of the things I like the most about them, how consistently they're able to perform so well. However, that streak actually ended this last quarter where they reported a super rare miss on both the top and bottom line, which was in large part due to similar challenges that Google faced, mostly having to do with the macroeconomy, which heavily affected the PC market, the advertising market, and even the cloud computing market, where Microsoft missed revenue on all three. Overall though, the misses were still very small, with EPS coming in just 6 cents short of estimates and revenue at 51.9 versus 52.4 billion. However, guidance for next quarter is even worse than this one at about 10% growth, which is less than analysts were expecting. So all of that sounds pretty bad, right? So why then did the stock go up? Well, for one thing, they're hugely important Azure cloud revenues were still up a massive 40% year over year, and the CEO noted that despite the horrible economy, they are still seeing larger and longer term commitments with a record number of over 100 million and over $1 billion deals being accepted for Azure, which indicates really strong demand for their cloud services even with the horrible economy. And it also means that they're doing a great job of competing against other giants like Amazon and Google in the cloud space. FYI, Azure currently holds the second most market share right in between those other two. Plus, a lot of the issues came from foreign exchange rates that are really out of Microsoft's control anyway. In other words, Microsoft as a business is still performing extremely well, and as such, they reiterated their guidance for the following fiscal year of double-digit sales and profit growth, which was excellent news. So considering that the stock is still down about a fifth of its value even after the recent rebound, in what is also, one of the largest and rarest drops that we've ever seen in the stock, just like Google. And yet this is a giant dominant company that did almost 170 billion in sales last year, with over 60 billion of that going straight to the bottom line, and it's still somehow consistently putting up double-digit growth rates every single year, which is not changing according to their guidance. Well, I just have to stick with what I've always said about Microsoft. As long as it's on a large dip, the stock should be rated a buy. The only issue is the rich valuation for me that is a bit more expensive than the sector. So I almost want to give it like a buy/hold rating just because of the valuation. But long term, that valuation usually doesn't matter much with Microsoft. As long as it's being bought on a dip, it's usually a good solid pickup. And so I'm still going to rate it as a buy here, and especially if it was to dip even lower. Okay, now if you're looking for a stock with a cheaper valuation and you want something that has been absolutely destroyed recently, well, next up we have Facebook and Instagram parent company Meta, ticker symbol META, who reported earnings the following day at the close of trading on Wednesday. And as you can see, there was initial optimism that was probably fueled by the other giants like Google and Microsoft that sent the stock soaring by close to 7% on Wednesday. But once that earnings report came out, the stock crashed and was down over 5% the next day, another 1% drop on Friday, and then finished the week still down over 6%. And in total, Meta is now down almost 60% from its highs, losing more than half of its entire value, and is sitting right around the same levels as the 2020 lows. So it's really as if all the gains from the pepperoni lockdowns and the pandemic never even happened, where they actually more than doubled their profits throughout that time. The great performance, though, is making it really hard for Meta to grow this year by comparison, especially as they try to restructure their business over to the metaverse during a horrible macroeconomy. In fact, CEO Mark Zuckerberg literally pointed to the economy, saying that we have now entered an economic downturn that will have a broad impact on digital advertising, and as such, they will need to stop hiring people like they used to and become more efficient with less resources, which is something that we've been seeing a lot of companies do, laying people off, hiring less, things like that. And because Meta is the second largest digital advertising company in the world, the declining economy caused Meta to miss estimates on both the top and bottom line, although to be fair, they were very small misses, and they actually still saw an increase in daily active users, but the real story is how their sales decreased year over year by about 1%, with guidance for the next quarter to be another drop of at least 2% as well. To make matters worse, the privacy changes from Apple are resulting in a $10 billion hit for them this year, while their virtual reality division continues to burn through money with another close to $3 billion loss this quarter alone because of the heavy investment into the metaverse. Needless to say, Meta is absolutely a company that is in a transitionary period right now where growth is going to be very limited and negativity will likely dominate the headlines for some time. But I continue to stick with my opinion that selling the stock has been way overdone at this point, and people are forgetting just how massively profitable this company is, with almost $60 billion of operating cash flow over the past year alone. There's also a large revenue recovery that is expected next year of over 12%, even with all the headwinds in place, which will top over $130 billion in sales. They also have one of the best balance sheets in the world, and they're also likely to be one of the biggest players in the metaverse because of their heavy investment that is really topping any other company in the world. So, with this stock already down by so much to the point where this giant behemoth is actually trading about 10 to 20% cheaper than the sector on a PE ratio basis, I mean, why wouldn't I want to take a chance on it and pay a cheaper price for something with huge future potential in the metaverse that I think, could be the next big revolutionary thing to happen to the internet. And even in the meantime, during this transitionary period, I still get the world's largest social media company with over 80% market share and insane profitability. In my opinion, Meta is a great value right now, and I continue to rate this a buy, especially the lower that it goes. Okay, after that though, we had Apple and Amazon who took the spotlight on Thursday, with Apple reporting after the close that day, which sent the stock climbing by over 3% the next day, leaving it up over 5% for the week. So, not as big of a response as maybe some of the other stocks that we've talked about so far, but still, good solid performance for them overall. And that's because the earnings were pretty good themselves. Not only did Apple beat on both the top and bottom line, but they even expect their growth to recover a bit throughout the year despite the horrible economy. Now, it's good that they beat estimates, but that doesn't necessarily mean that Apple is growing themselves. In fact, those estimates were already very low to begin with, so even though they reported EPS of 120 versus 116 expected, it was still actually a decline year over year of about 8%. And even though revenue did see an increase, it was only about 2% of an increase, mostly because of iPhone sales that rose about 3%. But the bulk of their growth right now is still coming from their services, which rose a strong 12% year over year, but it's still not large enough to make up for the weaker sales that are just kind of very cyclical throughout their business. For example, you had other products like, the category other products, and then you also had Mac and you also had iPad. All three of them saw significant declines. Still, this is the name of the game for Apple now. I mean, you're talking about a hardware business that is always going to be cyclical, but when they get their customers hooked on the ecosystem, they're going to sell them more and more services that will stack on over time, and that's where you're going to get the consistent growth. Then their customers will upgrade their hardware on occasion, which will be the more cyclical part. It's definitely a winning combination for them, don't get me wrong. I mean, it's already resulted in over $350 billion in sales and almost $100 billion in profits just last year alone. But where you see the cyclicality in all of this is in how sales and profits grew by 33% and 67% respectively last year, but both are dropping to single-digit percentages in the following years. Here's revenue, and then I'll show you here. This one here is for EPS expected on average over the next 5 years. Both are in the single-digit percentages. Don't get me wrong, I own Apple stock and I feel very confident about it long term because of their massive size, the balance sheet, the stickiness to their business, but I just think that with a market cap that is already above $2.5 trillion and some PE ratios that are a bit more expensive than the sector, I just don't think that Apple is as good of a value as maybe the other stocks that we've already talked about, or even a number of other stocks that are available in the market that I frequently make videos on. So I probably won't be buying any more of the stock at this time, but instead, I think I'm just going to be holding on to my position. So if I had to rate it, I think I would rate it a hold at these levels. Still a solid company, long-term pretty safe play, but not something that I want to buy at this time. So it's a hold for me. All right, and finally, that leaves us with the last stock, and that was Amazon, the almighty Amazon, ticker symbol AMZN, who also reported at the close of Thursday's trading, which sent the stock soaring by over 10% the following day and for the overall week. That's because just like Apple, Amazon also beat analyst estimates and gave upbeat guidance for the rest of the year. Now, profits were actually negative in the quarter, but that's because of their investment in the electric vehicle maker Rivian, who's been seeing their stock crash and causing Amazon to make write-downs worth billions of dollars. But more importantly, Amazon was still able to beat on revenue by billions of dollars with year-over-year growth of 7%, which they actually expect to accelerate in the following quarter at 13 to 17% growth, even with the declining economy. And a couple of their most important businesses also beat estimates, like their highly profitable cloud segment in AWS and their newer high-growth advertising segment, which is an area where basically every other company in the market seems to be struggling. But because Amazon is a smaller player than Google or Facebook, or I should say Meta, they've actually benefited from being able to steal market share as they grow into a larger competitor. Unfortunately, though, Amazon did have to lay off almost 100,000 people this last quarter because of the macro economy, but that's something that practically every company is doing right now, and it's also coming after more than doubling their size during the pandemic, so a correction was probably needed anyway. In any case, Amazon continues to show strength regardless of what the economy is doing, which makes total sense to me. I mean, literally everybody I know has been using Amazon to make the bulk of their purchases more and more often. I mean, I see people using Amazon all the time. I constantly see Amazon trucks driving by. I constantly see packages being delivered. Amazon is just on fire as a website, and it's resulted in them having controlling more than half of the entire US online shopping market in terms of market share, while also they continue to hold by far the most cloud computing market share in the entire world as well. Overall, it's resulted in them doing almost $500 billion in revenue last year while still somehow managing to grow by double digit percentages. Yet the stock is still down almost 30% from its highs. And as long as that continues, as long as it continues to struggle here, I myself will continue to call Amazon a buy. So there you have it, guys. I rate Google, Microsoft, Meta, and Amazon all as a buy. That's what I feel about them, especially long term. Probably Microsoft is a little expensive still, but I still think all of those are a buy. And then I would rate Apple as a hold, or maybe even a sell if you're trying to lock in some profits. You just really need some profits, maybe a sell. But personally, for me, I'm still holding it, and I consider it a hold. It's still a great company that I'd want to hold it long term anyway. Anyway, that's gonna do it for today's video. What do you guys think? How do you feel about all of these earnings reports, about these stocks? Are you invested in any of these? Do you think any of them are more or less attractive coming off of earnings reports? Are you thinking about buying or selling any of these? I'd love to hear your thoughts, and I'll try to respond to as many comments as I can. But thank you so much for stopping by. Thank you for all the support. It means the world to me. And I will catch you in the next one. Hope you're all doing well. Take care. Bye-bye.